Traders, welcome back to another trading psychology masterclass. And in today's masterclass, we're talking all about how mastering your emotions and your trading mindset will help you make more money as a trader, and how important it is to master your emotions and your trading mindset to be able to have consistent profitability as a trader. It's the traders that do master their trading mindset that are able to sustain their success and have consistent profitability. It's those that don't, that are run by fear and greed and are ultimately taken away from their trading plan, are run by their emotions, they're highly stressed, and they don't have consistent profitability. They go through what Mark Douglas explained as the boom and bust cycle. Now, one of the greatest investors of all time said, don't expect to manage your money if you can't manage your emotions. Don't expect to control your money if you can't control your emotions. So what I want to do in this masterclass is give you some insights on how you can manage and control your emotions. Very simple tool, if you wait to the end of this video, a very simple tool that you can implement before every single trade to ensure that you're making a decision that's in alignment with your trading plan, which ultimately means that you're going to be in alignment with your edge and on track to consistent profitability, and also a decision that's you're not going to regret later on. You're not going to have strong emotional volatilities because you're making a process-based decision. Now think about it. Consistent profitability as a trader comes from consistently executing on a trading edge. You can't consistently execute on your trading edge if you don't have an edge in the first place. So you need to make sure you have an edge, put it into a mechanical trading plan. But the other thing that's going to stop you from consistently executing on your edge is fear and greed. It's those emotional volatilities. So once you have an edge, once you have a trading plan that's developed, now it's about mastering your psychology and focusing on making process-based decisions, managing fear and greed in the market so you can stick to your trading plan, you can stick to your processes, and ultimately have consistent profitability. That's what this particular masterclass is going to help you do. So let's get into it. Now, let's understand your emotions on a little bit of a deeper level. Your emotions are not bad. I don't want to set this misconception that your emotions are bad. You have to get rid of them. You have to be emotionless. One, that's not realistic if you're in a physical body. Your senses as a human being work on judgment. They work on contrast. So as long as you're in a physical body, you're going to be judging, you're going to be having emotions. It's just part of your existence in a physical body. Now, your emotions aren't bad. They're not something that you should try and get rid of. Rather, they're something that you should understand. They're something that you should moderate, and there is something that you should use as a feedback mechanism to understand what's going on a deeper level. So I encourage you not to see your emotions as bad. I encourage you to see them as a necessary feedback. And I also encourage you to learn how to manage your emotions and to moderate them. Because you don't have to go through wild swings of fear and greed and elation and depression and extreme happiness and extreme sadness. You can learn to moderate your emotions and bring them closer to center so that day to day you have very little volatility. That's what emotional volatility is. Rather, you're a little bit more balanced, you're a little bit more poised, you're a little bit more process-based. And it's those individuals who are very balanced on the outcome and stick to the processes that ultimately get great results. Whereas you see some people who swing, sometimes they're doing really well and really happy and really elated. And then guess what? The next week they're really sad and really depressed. And they're ultimately going in circles, chasing their own tail, as opposed to being someone who's a little bit more balanced, a little bit more process-based, that starts to ascend. So ultimately, this masterclass is going to help you stop chasing your own tail, going in circles, and start to ascend a little bit. Now, traders should not seek to remove their emotions. They should seek to understand them. Your emotions are a necessary feedback. And I want you to think about it this way. If you are in an environment where let's say, for example, you take a winning trade, and in that moment, what you're registering on your brokerage is profit, and in your mind, that profit supports your priorities. That profit is, in your mind, good because it can help you pay rent, it can help you get food, it can help you get something nice, whatever it may be. So you're taking this information into your mind and you're perceiving more advantage and drawback in that moment. You're going to label that good. You're going to have a positive emotion. You're going to have an infatuation. You're going to have a pride over that. So that emotion in that moment is determined based on your ratio of perception between good and bad. So throughout your life, you would have associations of money is good or money is this, and in this situation it's good because it helped me here, etc., etc. And in your mind, you are now taking in that information. It's reminding you of those good associations. You're perceiving more advantage and disadvantage, and you're having a positive emotion as a result of that perception. So your emotional reaction is a direct result of your perception, the ratio of perception between good and bad, positive and negative in that moment. And that ratio of perception of good and bad is determined based on a lot of your previous life experiences and your value system, your priority system. If what is coming in supports your priorities, you're going to label it good. Now, whenever you perceive something as more challenging than benefiting, you're going to label it bad, negative, resentful, shame. You're going to have the negative anger, resentment, emotion as a result of that perception. Now, here's the interesting thing. There's an interesting analogy that I've heard Dr. John Demartini use, which I think is super interesting. He said that you can have heavy rainfall on a day, and the rainfall is falling. It's part of the natural cycle, right? But an individual who's getting married on that day, a bride who's having their perfect day that's all planned out, and that heavy rainfall is ruining their perfect day. It's ruining their hair, ruining photos, ruining etc., making it difficult for the guests, ruining their clothes. That individual is going to perceive more drawback than benefit in that moment, and as a result is going to label that event, rainfall, heavy rainfall, as bad. However, 200 meters away from them, there's a farmer who has crops to grow, and that rainfall, that heavy rainfall, that same heavy rainfall is supporting that farmer's values, more benefit than drawback, and they're labeling that very same thing that bride and groom were labeling bad, that farmer's labeling good, because in that moment it's helping them. Simultaneously, it's helping that farmer. So that little analogy there shows you that heavy rainfall can be labeled good, bad, or anything in between, depending on whether it supports or challenges your priorities, your values in that moment, and your ratio of perception of that same event. It's not the event that's good or bad, it's your perception of it. Okay, so we're going to use that little analogy in the markets, and we're going to bring that forward, and we're going to talk a little bit about that in today's masterclass because it's useful. Now, the neutrality of the markets, where do you stand? And it's a choice usually. From the market's perspective, if you think about it, you have the market that stands above, an overview effect, and then coming down from it, you've got a winner, you've got a loser. So from the market's perspective, every winner has a loser, every loser has a winner. You've got the market, you've got buyers, you've got sellers. You've got a winner, you've got a loser. You've got a winner, you've got a loser. You've got a seller, you've got a buyer, whatever it is, all right? But from the market's perspective, the market stands above and has an overview seeing both the winner and the loser, and it doesn't judge good or bad. It's only the winner or the loser that judges good or bad because they've taken a stance in the market. So from the market's perspective, the outcome is neutral. From the market's overview perspective, it's going from the buyer to the seller. It's going from the seller to the buyer, whatever it is. From the market's perspective, the transaction is neutral. We only label a loss when it runs counter to our idea, counter to our expectation. Let's say, for example, we're looking at euro-dollar to go to the upside, and we put money on euro-dollar to go to the upside. We've now set an expectation. We have an expectation on the outcome. And if euro-dollar goes to the downside, we're labeling that bad, negative, painful, only because of our expectation, the money we've put down. We've taken a stance, and now we're, in our mind, losing money, and we're going against our expectations, so we're going to label that bad. However, someone's taken the exact opposite side of that trade, and they're labeling that movement good. From the market's perspective, it's neither good nor bad. It's a neutral movement in the market. It's a transaction. Okay? So we only label something a loss or bad when it starts to run counter to our ideas, and it challenges our ideas, and it challenges our priorities and our value system in that moment. We have to understand when we're labeling it bad, simultaneously someone's labeling it good. Okay, so it depends on where you stand. It depends on your perspective, in other words. We only label something a win when it runs in the direction of our idea. So we can use that same analogy in complete reverse. We're labeling a movement good because it's moving in the direction we expected. We're making money, but simultaneously someone's losing money on that trade. So if you think about it for a second, every elating trade you've had that's made you money, someone's labeled that depressing and lost money. And every depressing trade that you've had that's lost you money, someone's labeled that elating. and made money. Now, from the market's perspective, that stands above the buyer and the seller, the winner and the loser. The market's labeling that neither good nor bad. It's not judging it. So what I'm trying to communicate here is there's a place you can stand, the perspective you can have that rises above the good or bad, the polarities of the market. So you're labeling your wins and losses neither good nor bad, more as a neutral thing. The outcome is neither good nor bad on the individual trade. So you can stick to your trading plan, you can stick to your processes, and you can ultimately have consistent profitability because you're not fearful or greedy over an individual trade. You're sticking to your processes over a large sample space. Okay, I hope that makes sense. So it's only in our mind that we choose to make the market's movements either good or bad. The market's movements are neutral, but we take that information into our brain and then we compare it to subconsciously stored baggage, and then we interpret that information as good or bad. The problem here is when it starts to disrupt your own edge. So both losses and wins are an essential part of consistent profitability. You have to understand that. To be a consistently profitable trader in a probability model, you need to both win and lose. You need to take wins sometimes, you need to take losses sometimes. Now, although a trader should seek to minimize their losses and maximize their wins, these decisions must be made based on processes and data, making data-driven decisions, not out of fear and greed. It's not about, I'm fearful, I need to close the position. I'm greedy, I need to make more. That's instinctive trading in the moment. That's going to be emotionally run and not based on data. It's based on your subconsciously stored experiences of the past that may or may not be related to the market, that you run off pleasure and pain as opposed to run from processes and data. So both winning and losing are an essential part of trading. Traders therefore must learn to transcend the pain of losing and the pleasure of winning so that you can encompass and you can experience both wins and losses as a way to just stick to your trading plan. It's ultimately about that, going back to your trading plan. No matter what happened on the previous trade, I'm going back to my trading plan. I'm sticking to my processes, making a process-based decision, and I'm sticking to my edge because I know if I consistently execute on my edge over a large sample space, I'm going to end up profitable because that's what the data shows over previous data. As opposed to traders, I took a loss, I'm fearful, I'm no longer going to execute on my trading plan because I'm fearful of taking another loss. Or I took a previous win, I'm extremely elated, I'm self-exaggerating, I'm going to project a shitty, low-quality setup onto the market. The latter example is the amateur trader, the former example, the one that's transcended the outcome, the emotions and the outcome, they're balanced on the outcome, they just stick to their trading plan over a large sample space. That's what the professional traders are doing. So, if you're positively emotional after a previous win, you're going to go into pride, into greed, and you're going to project low-quality setups into the market. You're not sticking to your trading plan in those situations. You're forcing ideas onto the market because you think you're better than the market. You feel invincible. You're disregarding risk in the market. So too, if you're negatively emotional after a previous loss, you go into fear, you go into shame. You're too fearful to act when the market presents an opportunity that's in alignment with your trading plan. In that situation, you're not sticking to your trading plan either. So in both emotional states, positive and negative, fear and greed, positive and negative, up and down, a trader is taken away from their processes, away from their edge, and ultimately away from consistent profitability. This is what kills your ability to make consistent profits from the market. So a trader must learn how to manage their emotions if they want to make consistent profitability. I'm going to give you a tool in this little masterclass to help you start doing that. So the solution here, make sure you do this. You have to train yourself to understand that your emotions aren't bad. They're a feedback. They're giving you an indication of a much deeper thing. And when you have a negative emotion, you have to be aware. You're already aware of the drawbacks because you're consciously aware of taking a loss. All right, in this moment, it's challenging my priorities. I'm labeling it bad. You're already consciously aware of that. So what traders tend to do is they go and get their journal and they go journal about how bad this experience was, just affirming that story, and as a result, perpetuating that negative emotion. What you need to do is you need to stop yourself, hold yourself accountable, and you need to make yourself conscious of the other side of that. What are the benefits in that situation of taking a loss? Well, maybe you're self-exaggerating, projecting low-quality setups onto the market. You had unrealistic expectations on the market, and taking a loss grounded you. It made you more present with the market. It made you more accountable to sticking to high quality setups in your trading plan. Maybe that loss made you more open and teachable, made you realize that, you know what, there's uncertainties in the market and I have to continue to learn and grow and develop as a trader. And maybe that loss made you aware of the risks in the market and the importance of sticking to your rules and the importance of proper risk management. And it's kind of like when you touch a hot stove, now you're a little bit more careful around that and you're more process based and you're more sticking to your trading plan. There are benefits to losing. And then if you take a win, you're already aware of the benefits, but now you have to make yourself aware of the drawbacks, because if you're elated after you win, you're more likely to feel invincible and project onto the market, not stick to your trading plan. So what you have to learn to do is you have to learn to be aware of the drawbacks. What are the drawbacks in this situation? How can I humble myself so I don't need the market to humble me? So when you take a win, what are some of the drawbacks to winning? Well, winning tends to puff us up into the state of invincibility, and then we start to take low quality setups. Winning tends to make you feel like you don't need to learn anymore, you don't need to grow, and you can get this feeling of overconfidence that you have figured it out, whereas the market's constantly evolving and you here sitting here thinking that you've figured it out, you're gonna be left behind, kind of thing. So there are drawbacks to winning that you have to be aware of to keep yourself present, grounded, and just sticking to your trading plan. So expanding your awareness in the situation will help remove the emotion and help you be present with the market, aware in the market, and make process-based decisions according to your plan that ultimately lead to consistent profitability. You also want to do this. Your emotional state after a trade is heavily influenced by your expectations prior to a trade. So you want to be aware of your outcome-based expectations prior to going into a trade. And it's these expectations that are going to take you away from your trading plans, these expectations that are going to anchor you in your mind. And if you get anything less than that expectation, you're going to be angry in the market. So you want to be using the free tool that I've put in the description. It's a free Bulletproof Your Mindset tool. You want to use that before every single trade you take to help you be aware of the expectations in your mind, to help you ground the expectations, and to help you stick to your trading plan. That's what the tool is going to help you do. So make sure you go into the description, download that free tool, completely free, watch the free walkthrough and education that comes with that, and then use that Bulletproof Your Mindset tool before every single trade you take. Do it for 30 days and see the difference it makes. I guarantee you, after every trade you take, adhering to that Bulletproof Your Mindset tool, you're going to be less emotional and you're going to have greater stickability to your trading plan. And as a result, you're going to have greater consistent profitability because now you're sticking to your edge and sticking to your plan. Now, if you found this useful, please share it with your trading friends, share it in your trading communities. Let's get more of an awareness of trading mindset out there. And I look forward to like, comment, subscribe, all that good stuff. Show me you're getting value from these videos. And I look forward to seeing you all in the next videos.